I welcome you all happy investors to all the people who have been watching all of these value investing series. And if you are a new visitor and if you are watching this video and me for the first time, let me tell you that I respect you the most and I love you the most, and I'm here just to share each and every value which I have, each and every knowledge which I have learned from different YouTube videos, different mentors in my life, different entrepreneurs which I follow, and I am here present in this video just to share what I have practically applied in my life. I have received the results of that hard work, and I am sharing all the knowledge which I practically implied, got the positive results, and now I am here with all the positive values, all the things which you can also learn. Check out in the internet, check out in the platforms, check out in the tools which I am providing you, and then while doing your own study you will get to realize that this knowledge free of cost in this YouTube channel is just amazing. It's not me, it's all the people who are watching this video is going to say in their mind, and I hope that from deep inside, I hope that you get to learn the best benefits from this video. So if you are a new visitor, if you are a new person who is just watching this video for the first time, I'm linking up this card up here somewhere, and what this card is having. Right now we have already published 6 different videos of stock primes, and those videos are completely based on value investing, where we have taught about PE ratio, book value, earning per share, PB ratio, banking shares, just like you can say lots of banking terms which you are going to learn from that video, just like CASA percentage and cost of liabilities and advances growth and NPA percentage and NIM percentage and ROA percentage. You are going to learn so much of values from this card. And one more thing which I need to tell you, just if you go through all these terms and start doing value investing by your own, then you are going to just get lots and lots of profit. But don't take it as a financial advice. Just do your own study based on these terms, analyze the market, and just release this one thing from your mind, that earning money is a very hard process. It's not. It's just depends on what thing which you are doing. Right now in this video we are focusing on 2 different terms which many people have doubts on, and that is going to help you. If you have watched those 6 videos, then this Stock7Prime video is going to help you in these value investing which you are going to do in your next free time. So very good evening to you all. My name is Shubham Bish and I welcome you all once again back to this amazing platform of YouTube named as Happiness Prime. I think I should keep it Stock Prime, but yeah, Happiness Prime. And this Stock 7 Prime video, where we are going to learn about EBITDA, EBITDA, how to calculate EBITDA, what is exactly EBITDA, and apart from that we are going to learn about PEG ratio, how to get to know that a company is overvalued or fairly valued or undervalued, and how to pick up the best company to enter in the right time and earn the maximum amount of profit from that. So let's start with the first term, which is EBITDA. If you don't have a pen or a copy, I'm just reminding you, just run and get a pen, get a copy and start writing with it, because these are the terms which are going to help you a lot while doing value investing, while picking up a stock which you are going to invest your money on. So let's start with the first term, EBITDA. What is the full form of EBITDA? Is the most of the people have this one thing in mind. It is very simple. The word is very interesting, EBITDA. So the full form is earning before interest, tax, depreciation and amortization. Very simple. Earnings before interest, tax, depreciation and amortization. Now what is the actual use of EBITDA? EBITDA is used to just deliver. It is used to, you can say, if I want to know about a company's profit and is it the company is making financial growth, if I want to see that company is having, what is the company's financial performance, then EBITDA is one of the best ratios which can tell me, or the formula which I have for EBITDA. This formula can tell you that is the company really making good financial growth, is the company is having good financial performance in the last few years. And if you want to calculate, or if you want to compare it with other companies of the same industry, just like if you are doing it for a tech industry. So in tech industries, you can compare the different EBITDA ratios of different companies, which is going to help you a lot. Also, one more thing, that EBITDA eliminates the effect of financial and accounting decisions. So it helps a lot determining the best company for you, which is actually making financial growth. Financial performances are very good and they have a high ratio, high intensity to grow in the near future. Now, this thing is very off. So let's start with the first thing, how to calculate EBITDA. See, first of all, we have two different formulas to calculate it. It is complete uncut version. This thing is complete values, and I don't care about the whatever thing it is. So let's start with the two formulas which I have for you. Let's concentrate again back to the EBITDA. We have two formulas for you. First formula to calculate EBITDA is it starts from the operating income. The second formula starts with the net income. Now let's talk about the first formula to calculate EBITDA. What EBITDA do? EBITDA tells you that is the company having a good financial performance, is the company having a good financial growth or not. So first formula is taken out by operating income. It starts with operating income. So EBITDA is equals to operating income plus depreciation plus amortization. I'm going to repeat it once again. EBITDA is equals to operating income, operating income plus demortization, depreciation. I'm very sorry about that word, is very quickly just comes out. So operating income plus the amortization plus depreciation. So this is the first formula which you have to, which is going to give you EBITDA. Now what is operating income? Let's talk about what is operating income. Income which comes out after excluding the operating expenses. Now what is operating expenses? The money which is the expense which the company is doing to do the regular day-to-day business. The expenses which are happening to run the daily business, it is known as operating expenses. And the income which is generated after deducting the operating expenses and before eliminating the interest and taxes is known as operating income. I hope you get it, because the operating income is always with the interest and tax. So an amount which is already having income, which is already having the tax, interest and taxes, and now we have to add amortization and depreciation. Once we add all these five terms, we get the value of EBITDA. This is the first way to calculate EBITDA. The second way, I hope you got to learn about the operating income. It is very easy. Operating income is calculated when we exclude the operating expenses. Now what is operating expenses? Operating expenses are the expenses which the company is doing to run the daily business, and the operating income is already consisting of the interest and the taxes amount. So we just have to add the depreciation amount and the amortization amount to just get the EBITDA value. This was the first formula to calculate EBITDA. The second formula to calculate EBITDA is also very simple. EBITDA is equals to net income plus interest amount plus taxes plus amortization plus depreciation. So this is the next formula, that is the second formula to calculate EBITDA. All these terms are very easy. Net income and interest and taxes, all of these informations you will find in the income statement of the company, in the website which I have already linked you, the tool which I have already shared you in the past 6 videos. There you will get to know about the income statement, and there you can get the value of net income, the interest, the taxes, and depreciation and amortization terms you will find in the cash flow statement. In the cash flow statement you will get to know the values of these two terms. So I hope you got to know that why we use EBITDA, how to calculate EBITDA. But one more thing which I need to tell you, that EBITDA is a term which is not officially regulated. It is not officially corrected or checked by any government employee. So even Companies can also play with these terms to show that they are doing much profit, but in actual it is not. So you have to always see this one thing, that EBITDA is always going to help you only when you are doing the value investing or the financial stock comparison of the similar type of companies of the same industry. When you are comparing different companies of the same industry, then EBITDA is one of the nice ratios to have a look on. This is the thing which you need to figure out, you need to listen, and this was the complete explanation of what is EBITDA, how it is important while value investing, and how to calculate EBITDA. Now let's move on to the next thing which we were going to talk about, that is PEG ratio, PEG. PEG ratio is price to earning. PE ratio we all know, right? I'm going to link up a card here about PE ratio. So if you don't know what is a PE ratio, price to earning per share ratio, that you are going to look up in this video. So PE ratio divided by the growth of the company, the profit growth of the company over the years, is going to give us PEG ratio. Now you might be thinking that what is PEG ratio? I think Shubham have missed the PEG ratio. So what is PEG ratio? PEG ratio is a ratio which determines that company is fairly valued, overly valued, or underly valued. If it is underly valued, then it is the best position for you to earn maximum amount of money from that particular company. But yes, only if PEG ratio is good and you have neglected all the other ratios is not the right option. You have to see the PEG ratio. If it gives you a positive signals, then you need to go to the other terms also. So PEG ratio always determines that company is having a good PE ratio, or the PE ratio is just, see, PE ratio can be high due to multiple reasons. If the PE ratio over the years, PE ratio over the years is showing a 5 to 10 gap, not more than that, not more than 5 to 10, that figure. So if it is maintaining a particular margin and it is moving in the same direction, then it is a very nice PEG ratio is having a much more importance in this particular case. But if the PE ratio is in this stage, that might be happening due to multiple reasons. The first reasons why PE ratio is increasing in this stage, like it is moving very fast, that can be have two reasons. Firstly, the stock might be overvalued and lots of people are buying the same stock at the same moment, at the span of days. So that is one reason why PE ratio can go very high. Secondly, PE ratio can be high if the company is having good profit growth over the years, and company is getting more deals and more manufacturing unit and more licenses from the USADA. So this is one of the reasons why PE ratio can increase very high, or it is just an overvalued stock and it is people are buying in bulk that stock, that is why it can be high. So if this PEG ratio is only important if that PE ratio is stable and it is moving in a 5 to 10 range, then it is a good ratio. Now what I need to tell you by the PEG ratio, that if you divide the PE ratio divided by 3 years profit growth, that is, if let's say example, if the PE ratio of a company is 35 and the profit growth of the company over past 3 years is also how much, 35, right? Let's take another example, like if the PE ratio is 35 and the profit growth percentage in the last 3 years is also 36%, so it is somewhat around 1. If it is somewhat around 1, then it is a perfectly valued stock. If it is below 1 and very below 1, then it is a very undervalued stock. And if it is above 1 and a lot of above 1, so it is a overly valued stock. So that you have to figure out. And if the 3 years profit percentage growth is not giving you perfect results, or it is showing you above 1%, then what you can do, you can check on a 5 years profit growth percentage. Take the PE value divided by the profit growth percentage in the 5 years, and the value which you will get, if that is nearby 1, then you can shift towards the 1 year growth ratio. If the 1 year growth ratio is the final decided that what you need to believe on the 3 year mark or in the 5 year mark. I hope you got to learn about this particular thing, and I am going to show you with this example also, because this is really a little complicated. But PEG ratio is one of the best factors which you can look at, and it is very necessary that you go through these factors and you learn the best from these factors. So we are going to take a live example of PEG ratio. Let's move on to that.
Let us now see some live example of PEG ratio, and we are going to discuss like how you can figure out a company is overvalued, undervalued, or perfectly valued. And on the basis of PEG ratio, we are also going to figure out a few companies. Like live in this video, we are going to figure out a few companies. Here you can see the page of ticker phenology, and if you scroll down, you can see top today's gainers and today's losers, and 52-week high companies and 52-week low companies. So here let's figure out some VRL logistics. Let's check out what this company is showing right now. See, this company is logistics company, and first thing, like while figuring out a PEG ratio is really worth for VRL logistics, we have to first go, the first step is to go and check the PE ratio over the years. Yes, see, the PE ratio in December 2019 was 22, then it went 0, then it went to 229. So this is not stable P ratio. We cannot rely on this P ratio. That is why PEG ratio is not a good factor to measure on for the company VRL Logistics. Let's move on to some other companies. Let's check out some other companies which we can check on the basis of PE, on the basis of PEG ratio. Let's go to Burger King India. Let us see what is their hotel, resorts and restaurants. Burger King is a very famous stock. Let's go to the PE ratio. The PE ratio is 0 right now, so we cannot figure out on this company also. Let's check out some other companies. No issues. Let's check out some other companies. Let's go towards Gland Pharma. Gland Pharma's PE ratio, let's see, it is 0, and then it is 38.46, and then it went high to 61. So it is also not reliable enough. So PEG ratio is also not one of the kind factors of Gland Pharma. Let's go towards another company, that is India Mart Intermesh, that is a e-commerce company. Here if we see the PE ratio, see, this one's P ratio we can quite understand. Right now the company was trading in December, if we see at 5 years, the company was trading at 38-37 ratios. Then it went to 60, then it again came down to 40-36, then it again went to 74, then it again came down to 56, and right now the stock is trading at 72. It is quite high. I won't say it is quite average, but it must be around, if it is trading at 37, then it must be around 37 the entire time. Like it can be 45, it can be 30, but it cannot be 74. This shows that the PE ratio is increasing over the years, and it can have multiple factors, one of which is profit growth. See, the profit growth is the only factor. Companies growing so much in the profit that the PE has to increase over the years, and it is increasing. That is why PEG ratio is not one of the major ratios to study while doing India Mart research. Right, getting my point? See, in 5 years company was having 57% growth. Is it okay? In 3 years it was having 136.12% growth, and in 1 year it made 1061% growth. So yes, definitely PEG ratio is not an important ratio in this stock analysis. Let's move on towards some other companies. Let's see Motherson Sumi Systems Limited. It is an auto ancillary, and here if we see the PE ratio, see, the PE ratio is just increasing right now. Till December, till September, it was on a nice position. Let's say towards 5 years, this is what we call a stable PE ratio. But right now in this particular month, something has happened. If we check the last 1 year, see, it was on 11% growth, then it went to 2% growth, and it went to 10% growth. Something has happened, and people started suddenly buying the stock so much. Either the Motherson Sumi have got some good news. You can check on the Google. Right now the date is 18th May 2021, which we are making this video, and the moment this stock P ratio just raised is, you can say, August 5 to August 11. This is the moment, August 5 2020. You can check on Google. There might be some news about Motherson Sumi, this company Motherson Sumi Systems Limited, that is the reason why the PE ratio just went so high. If you check around, it's 11 August 11 2020. Let's check August 11 2020. So here if you see, It is August 11. See, 107 it was trading at, and then right now it is at 240. Almost 200% growth. So that is the only reason that something has happened in the company due to which the PE ratio increased and the price of the company increased. So till this point, if you check, till this point it was on a stable PE ratio. That is what we were talking about. So at this point, if you have seen that it was 67 PE ratio, that was a stable growth. So at this point, if I had to check the PEG ratio, then it was the best moment, but then the stock just went up. So that is one of the major factors when you have to enter while choosing the PEG ratio. Let's see about Adani Enterprises. Now let's figure out which is the best company to choose on. Now we are not going to completely go into the stock. Let's choose the best company on which we can just see the PE ratio is a stable one. Let's check out some companies. Let's check out some more companies. Shri Renuka Sugar, that is a nice name of the company. It might happen that we might find some really good stock in this research, and it is really going to be very exciting. So just hold on, just calm your breathe, and we are going to figure out some really good companies in this. Let's figure out of Tata Motors. Let's see the Philips. Let's see the Gateway. Let's see Shakti Pumps. I think it is a very nice stock. Let us see CSB Bank. Let us also see about this. Let us see Manorama Industries. Let us see that. Tata Motors PE ratio, it is 0. We cannot figure out PEG ratio for that. This is a quite stable one. Can we see that? Okay, it is decreasing over the years, and the price of the share is increasing over the years. This is quite a thing which we can study on. But yeah, see, this is the reason why the PE ratio is decreasing. This is the reason. 27% minus, that is the growth, profit growth is decreasing. This company had a very huge effect on its growth due to the lockdown, due to the COVID-19 issues. So it is not one of our companies. Let's go towards the PE ratio of this. This is looking quite nice. Not in the 5-year mark. Not in the 5-year mark. This was a nice table, but here it went 30. So you can check the reasons. Just because of this, it is going down. It is going way too down. So yes, this is also not one of our companies. Let's figure out about this. Just to know, just to see the PEG ratio companies, we are doing this. Not every single company is supporting PEG ratio. Not every single company is made to support the PEG ratio. We have to figure out which company is going on, and it is like this is the usual timings which it takes to just figure out some of the companies. This is where you have to invest time on. See, this is known as a stable PE ratio. This is known, the company was trading at 84, 69, 42. On March 2017 it was at 43, 42, and now also it is at 39. So this is known as a stable PE ratio. I hope you can see this is a stable PE ratio. So in this case, if you see the profit growth, it was 123% in the 5 years, it was 11% in the 3 years, and it was 13% in the 1 year. So first of all, we have to calculate on the 11.75%. On the basis of 11.75%, let's see the stock price at that point of time. It was somewhat around 28, 24. So if you divide 24 by 11, it will be around 2. So the PEG ratio is showing it is overly valued. Now this, if it is showing overly valued, you have to go towards the second one, that is 5 years, that is 123. So 123, and the stock price was 26. So 26 divided by 123, it is showing overly, like, so much undervalued stock. It is something around, you can say, how much is it, 24, that is 24 divided by 123, that is 0.19, which shows it is overly undervalued, very undervalued. So this is showing overvalued, this is showing undervalued. So the condition is we have to go at the deciding factor, that is 1 year. So 24 divided by 13, you have to do 24, that is the stock price, divided 24 divided by 13 percentage, that is 1.84. So it is slightly overvalued according to the peg ratio. It is slightly overvalued according to the peg ratio, but the stock just gave a breaking point here in April 2021. You can see 30 from 31 it went to 57. That is a very good growth. That is a multi-bagger. These kind of stocks are known as multi-bagger stocks, and we can expect a lot more from this stock. You can see it was trading at 20, 19, 20, 21, 27, and then it went up to 68. This is known as 300% profit growth. So all the investors who have invested in this Morpen Laboratories at when it was 22 rupees stock, they might have gone to a very huge profit, 300% profit on this stock. So this is how you can figure out a good company with a good peg ratio. Peg ratio denotes that which company is overly valued and which company is underly valued. But you, if that company is not supporting peg ratio, doesn't mean that company is not good. You have to go towards the PE ratio. You have to go towards the PB ratio. If it is a heavy industry, then you have to check out the PB ratio. Then after that you have to check out the depth. Is it having a high amount of depth? Then you have to go towards ROCE. If the company is having high depth, then you have to go towards ROCE. If it is having zero depth, then you have to go towards ROE. We are going to make a different video on that also. So this is how you do the research. We are going to make another video for that too, but right now it is already a very long video. So let's move on towards the last part of the video.
I hope you got to learn the PEG ratio with the live example and the EBITDA and the values that why EBITDA is important while doing value investing. There is no rain, there is rain outside, but this is all sweat, and that is just due to the one reason that if you have the similar kind of energy inside you which I am having right now, then you can also earn that much amount of money which I have in my mind and I have also practically implied. So I hope that you got to learn the best values from this video. I hope that you are writing down all the figures, and if you have any kind of questions, any kind of doubt in your mind, if you have any query in your mind, you can always comment down in the comment section below. I'll always be there to answer you. If you have any deeper queries and if you want just urgent answers, then you can DM me on the Instagram, which is linked in the below description section. I'm also available there, and I'm always available for you if you have any doubts. So I hope you got to learn the best values, and I'm really here just to share every single value which I am learning and practically implying and getting the positive results. So I hope you and your family have a very nice day. You got to learn the best things from this video, and I hope that you stay here, you stay tuned, you share this with one more friend, and you just keep more and more and more learnings from this Stock Prime value investing series. Thank you so much for watching this video. Just take good care of your family, of your loved ones, because them are like they are everything in your life. Take good care of them, have a positive environment around you, and always keep learning and loving your loved ones. Have a nice day, have a nice night, keep learning.